Thank you, Mr. Chairman, and welcome to our witnesses. In October, this committee held a hearing criticizing people who invest in and even build rental housing. It looks like that's on the agenda for today's hearing as well. Maybe part of the reason is a desire to change the subject from the failing Biden economy. This morning, we got a new inflation number. Inflation came in at 7.5%, the worst inflation in 40 years. And housing costs are skyrocketing even faster than the general rate of inflation. Rents increased around 12% last year. Home prices jumped an astounding 17%. And whether you are a renter or a home buyer, housing is taking up more and more of your paycheck, with inflation quickly eroding most of the rest. Now, wages are rising, but inflation is rising faster. And that means workers are falling further and further behind in the Biden economy. This is a direct result of the administration's massive overspending, and the administration is desperate to find someone else to blame. There's actually nothing wrong with people renting houses instead of or before they become homeowners. And there's also nothing wrong with investors, whether institutions or individuals, putting their own money to work to meet the need of these renters. It's a simple issue of supply and demand. Institutional investors happen to be the ones with the deepest pockets, the one with the most capital available to invest in building and the new housing stock that America needs. Just imagine how expensive housing stock would be if some of my colleagues got their wish and most institutional investors were driven out of the housing market. Instead of blaming those who actually build housing stock, we should probably take a look at the role that Democratic policies have contributed to the high cost of housing. Housing's expensive and getting more expensive in part because the administration has doubled down on 50 years of failed big government housing policies. Its illegal eviction moratorium, for instance, deterred landlords from investing in new housing stock and almost certainly contributed to rent increases. Its March 2021 wasteful $1.9 trillion spending bill included almost $22 billion in rental assistance, even though $25 billion in rental assistance Congress provided the year before was not even close to being spent. And this reckless tax and spend Build Back Better plan seeks yet another $35 billion in rental and down payment subsidies that will further increase the demand and push up prices in housing. The administration has also broken from decades of bipartisan efforts to reform the failed GSE model that now subsidizes the purchases of even million-dollar homes. And it's pushed the GSEs to take on more loans to risky borrowers. Today we'll hear from two witnesses, Tobias Peter and Joel Griffith, about the negative effects that these failed policies have had. They'll testify to the role of monetary policy in contributing to rapid house price inflation, and they'll testify to the increase in risky mortgage lending at the GSEs. Their testimony will make it clear that we need a different direction to improve housing affordability for all Americans, whether renters or owners. We should pursue reforms that leverage the power of free enterprise to increase housing supply and make markets more competitive. To that end, we need to scale back the role of government, increase the role of private capital. We need to phase out demand-side subsidies that just drive increases in housing prices and rents. And we need to end the failed GSE model that fosters excessive risk-taking and risks more taxpayer bailouts. We also need to end the GSE conservatorship that confer on the government far-reaching powers to replace market forces with executive fiat. The state of the housing market affirms the urgency of the reform. The housing market is cyclical. It's really a question of when, not if, there will be a housing downturn. And the housing finance system is not prepared. The system is still dominated by the very same GSEs that did so much to cause the 2008 financial crisis. The $7 trillion behemoths actually have an even bigger market share today than they had before the crisis, and they certainly remain too big to fail. And just as before the financial crisis, these flaws in the system continue to encourage excessive risk-taking, they risk future taxpayer bailouts, they undermine market forces, and threaten financial stabilities. And they do very little to make housing more affordable. So 50 years, and many hundreds of billions of dollars in federal housing assistance have been spent, and they have had no meaningful impact on home ownership rates. It was 64% in 1970. It was 65% in 2021. Now, last month, the chairman reiterated the housing finance reform principles that he had released in 2019. I would observe that his principles significantly overlap with the reform principles that I've released. I look forward to continuing to work with the chairman to see if we can get to a consensus on how to move forward on this really important issue. And I hope the administration will finally engage on this reform. Treasury has still not met its obligation to deliver its reform plan to Congress. It's now 4 months overdue. So instead of shifting blame for the reckless mismanagement of the economy, the administration should be looking for opportunities for bipartisan legislation like housing finance reform that relies more on free enterprise and less on government to make housing affordable for all Americans, whether they own or rent. Thank you, Mr. Chairman.